Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Saturday, April 1st, 2023, and this is Blockhead Traders Weekly. In this week's episode, I am just here by myself, and we are going to cover a few different topics this week. We are going to take a detailed look at premium selling, and we're going to go through two recent trades that I put on that I consider real just textbook trades of how you sell premium volatility. That is WAL and FRC. And we're going to look, they each had two different outcomes, but both of them really will be great examples to talk through all the mechanics of premium selling, which you hear a lot about in our Discord. But before we hop to that, I want to give a shout out to that Discord, link in the description below. You can hop in there, say hello to myself, the Viper, a few of the other Blockhead traders. Love to hear what you're trading, love to hear what you're watching. Additionally, this show is available wherever you get your favorite podcast from in an audio-only format. You can also find each and every one of my trades at thetagang.com/sprocket888. But let's hop to this week's content. And that is the detailed topic of premium selling. Now, premium selling, if you've spent any time in our Discord or if you drop by, you're likely to hear me put in the Discord various premium selling plays. There's a few other traders out there that do this high volatility trade where when volatility is high, we sell some options to collect some premium, and then we are banking on that volatility contraction and time and theta decay. And a lot of times if you read them or hear about them, you might be slightly confused because it is a pretty different trading vehicle than straight shares. So recently, with all the banking turmoil, there was some recent opportunities that came up in the financial names. And I took two particular trades, FRC and WAL, and they were textbook examples of the mechanics of premium selling. I mean, so much so that they were super exaggerated. So it really is a great example to talk through about the principles and mechanics involved to hopefully expose you guys to more of why it works, how it works. So when you hear us talk about this, you'll understand more about the angle that we're coming from and the trades that we're referring to. So there's a couple of key things that the trade must have before as part of its setup. And I kind of put them up here as just the three kind of kings of prerequisites for this type of premium selling trade. The first one is that the stock must be liquid. And I'm not really going to get into a lot of the liquidity discussion here. I mean, I'll show very briefly some of the metrics that I use to understand liquidity, but you really, really have to have a liquid underlying. The reason for that is really twofold. The first is the more liquidity that is in a particular underlying, the more that the price of the option chain, and the shares will be of a fair and accurate market value. So the more traders you have in there, the more that you have them trading hands, the more accurate the price discovery and the pricing of the different products actually is. So that's kind of reason number one. Reason number two, in the highly liquid stocks, you're going to be able to get in and out quickly. So when it's time to get out, you want to be able to exit. You don't want to be stuck in some of these names. And if you're trading options that are illiquid, it is going to be difficult to get out at a fair price because there's not going to be a lot of traders. So you're going to get a lot of slippage. And so really, if you stick to high volume shares or underlyings with high shares, so typically I'm looking at the 1 to 5 million shares traded in the actual stock. And then when you look at the option chain, I'm looking at the distance from the bid and the ask. So when you look at an option chain, you'll see a bid price and an ask price. The closer those are together, the more liquid the stock. And typically, I'm not going to touch much of anything that's separated by more than, say, 25 cents. So as long as that bid and the ask is, the difference between them is less than 25 cents, I'm going to go ahead and consider that liquid. Now, the most important part, and this is really the crux of the premium selling trade, is the volatility has to be elevated. because what you'll see in the coming slides is that is exactly what we are going to sell. We want that volatility to be super high, abnormally so from historical values, because we are banking on a mean reversion. We want to see that volatility come back down. So whenever somebody panics, something happens, volatility in the price will spike. When it gets really stretched, it's like a rubber band. You're going to get this kind of contraction, and it is always a mean reverting trade. Now, the time at which it mean reverts, that's not really that known, but we are going to increase our probability of success if we start with something that has already had volatility expansion and is already elevated, because we are selling that volatility. So we want to sell it when it is of the highest point. And then we will buy it back to close when that volatility comes down. And that's really the heart of what premium selling is all about. You're looking for an underlying that has gotten very volatile, and that volatility has increased the price of the options because everybody is very nervous about what that underlying might do. And the idea is, once everybody kind of calms down, the nerves come in, that volatility will contract. And so the mechanics here are that we are selling when it is elevated, and when it drops, we're going to buy it back to close it out. And we're going to buy it back at a lower price than what we sold it at. It's very similar to shorting a stock, except what we are shorting here is the actual volatility measurement. Now, the second most important factor of what we're doing is we are also banking on what's known as time decay in the options. So options have a part of their premium is theta, and theta stands for time. And so the amount of time that the option is still good for is the days to expiration, or DTE. And what we want is the more that option gets closer to its expiration, the less theta value that it has in it. So just like that volatility that I talked about, we want to sell it when it's high, and as it comes down, the price is going to come down to buy it back to close. Theta has a similar thing, is that when we sell it, from that point forward, theta will always be declining because we're going to get closer and closer and closer to expiration. And so the theta is not a linear decay, it's kind of an exponential decay. And where it really starts to drop off quickly is in the range of 30 to 45 days to expiration. So the theta decay is not so fast in much longer dated options, 120 days, 200 days, 365 days. Theta is declining, but it's not declining at a very fast rate. And then the closer you get to expiration, the sharper and faster that theta decline is. Now, because we're looking for that volatility contraction, and we're looking for aspects that make the option price go down quickly, these are the two factors that we are really going to hone in on. Volatility contraction, and then we're going to want to play the options that are in the range of 30 to 45 days, because that's going to give us sufficient time for that volatility contraction. It is also going to have a significant time premium baked into that price. So we're going to have the price of volatility and the price to expiration inside that option when we sell it to initially. And then theta is going to decline the fastest there, and then hopefully our volatility will also contract. These are the two primary factors that we're trying to accomplish when it comes to this premium selling option play. Let's try to visualize some of this here. So if we take a look, the option price that I'm referring to, an option has two aspects to its price. It has an intrinsic value and an extrinsic value. Okay. Now, the intrinsic value is the difference between the option or the underlying's price and the strike price that you have sold or that you have traded. You don't even have to sell it. Intrinsic price is something that cannot be taken away. So, for example, if I have an option and it is $100 strike, and the stock is currently trading at $110. And it's a call. That option has an intrinsic value of $10 because we have a $100 call, and the option is trading at $110. So it is in the money, and it is in the money by $10. Therefore, that option will have $10 of intrinsic value. When we are selling premium, we want all extrinsic value. We want everything to be done out of the money. So I'm not going to talk a lot about intrinsic value or in the money, because our trade is all out of the money, and our goal is to stay out of the money. Because when you're out of the money, there is absolutely no intrinsic value. So in the example I just gave, let's say we had a $100 call and the stock was trading at $90. That call option is saying the option holder has the right to buy those shares at $100. But why would you do that if the shares are trading for $90? You would just go to the market and pay $90. That option has no intrinsic value, because nobody will want to buy a $90 stock at $100 when they can buy it for $90. And so what I have here on the screen, and I kind of want to show you, this is an option chain of particular underlying, and it is split here. You see a column of intrinsic value and a column of extrinsic value. And the intrinsic value is, and currently this stock is somewhere around $35.50 or $36, somewhere in there. And so what you can see is the options that are $35 are out of the money. These are put options. And when they are out of the money, they have absolutely zero intrinsic value. Now, as soon as you start going in the money, this is where you start getting value assigned to it, simply because that is the distance from the strike price to where the option is trading. All of the Greeks that we are trying to target, all of the theta, the volatility that I just talked about, that is all represented in extrinsic value. That is value assigned to the option that is completely separate from the price of the actual option and the strike. That's why it's called extrinsic value. And this is exactly what we are going to trade as premium sellers. We want to sell the highest extrinsic value, and we are banking on two things to happen: time to pass and volatility to come down. Both of those will cause a contraction in that extrinsic value. So we will want to then buy it back for a lower price. Now, up here in the chart to the left and upper corner of the screen is a chart of extrinsic value for a ticker WAL. It is currently, at the time of this shot, trading a little bit above $35. And what I want to show you is that extrinsic value is like a pyramid or an arc or a hill. The highest extrinsic value is at the money, which means right at the stock ticker's price. And that's this peak right here. Now, what is being shown here is only extrinsic value. So there's no intrinsic value shown. So that's why you get this sharp fall off to each side. So the farther you get away from the money, the less and less extrinsic value there is. So, you know, if you get farther up there, the extrinsic value comes down, and depending if it's a put or a call, the intrinsic value would kind of come up. And you can see that in the chart down here with the strikes, that the bid and the ask is how much the whole thing is being paid for, is going for. And you can see that down here, once you get in the money, you're summing the intrinsic value with the extrinsic value. And the deeper and deeper you get into the money, the less extrinsic value there is, and it's more synthetically just trading the shares because you're much more tied to the difference between the strike and the underlying. Now, what we're hoping to see here in this extrinsic value is there's going to be a couple things that happen. And as time goes by and as volatility comes in, okay, so remember, extrinsic value are made up of all the Greeks. Volatility is one of the Greeks, and time is another one of the Greeks. And in the 30 to 45 day range, that is primarily what's driving price. And so what this mountain will look like if you watch the extrinsic value of the option. Now, the mountain will move as price moves, okay? But the other thing that's going to happen as volatility contracts and as time goes away, the mountain is going to get shorter and shorter and shorter and shorter, and it's going to shrink. So the magnitude and altitude of that mountain is going to recede as volatility comes in and as time goes by. And so that is what we are trading. Now, the other thing that's going to happen is once you sell the option, that mountain is fixed for whatever option price you sold. So the other piece of this is to also try to get the direction right. Because if you get the direction right and you have your decay, then you really get a drop off in price. So let's say in this particular example, we thought WAL was going to go up in price. Okay, so that is to the right of this chart. Now, as we go to the right, that extrinsic value is going to fall off quickly. Okay. Additionally, volatility comes in and time goes by. Now the mountain gets smaller. So not only are we moving down the hill of the mountain because we are traveling to the right, but the mountain is melting as we go down. And that is where you get very fast paybacks on the trade if you get the direction right and you get that volatility contraction and time passing. Now, what you're going to see in the following two examples when we get into the real world is you will see that you can also get the direction wrong and still be okay. And the reason for that is it's much slower because you're not going to get that rapid downhill the mountain moving to the right. You're just going to get the mountain melting. And so you're still, even if you stayed right at the peak of the mountain as volatility contracted and time went by, that peak's going to get lower and lower and lower. So you're still going to get the decline of that extrinsic value. It's just not going to move as fast because you're not skiing down the slope of this mountain because you also got the direction right. Now, the last thing I want to call out here on this particular image is this chart over here to the right and top. And this is a P&L chart. And this is one of the, I won't say confusing, but things you have to kind of understand. As that mountain is melting and the price is kind of moving, this purple line is the price or the total value of the option today. And then this light teal line is the value of the option. I shouldn't say the value of the option, the value of the trade at expiration. And so in this example, this option is selling a $35 strike. Okay, that is at the peak of the mountain. And it's a put. So the direction that we are saying this underlying is going to go is up. We are saying it is going to go up from 35. And as long as it goes up from 35, it is considered out of the money. And so if we held that to expiration, that option would be 100% worthless. We would keep 100% of that premium that we collected. Now, what you'll notice is this purple line is the value today. And that's because that value of the trade, not of the option. And the reason that that doesn't match up to this teal line is because there's cost associated to that option. That is the theta and the volatility. And so from the day that I sold it at 35, that, at expiration, it would be, $500. However, today, I would only, if I turned around and closed it out, I would basically be at zero because there's still $5 left in extrinsic value. And so as time goes by, this purple curve is going to come closer and closer and closer to this blue line as we approach expiration. Additionally, as we move left or right, we're going to move along this purple line in value. So if I get the direction right and we start going up, you can see if we get to $40, I might have $100 in profit. Now, the reason I don't have everything in profit yet is because there's still time and there's still volatility. And then if we went the other way and I got the direction wrong, now we're going to start picking up intrinsic value. Okay. And this intrinsic value is an enemy of me because I have made the bet with a put and I'm saying the option price is going to go up. And so my break even is actually not at 35 where I made the trade. My break even is actually going to be quite a bit lower because I collected premium of volatility and theta, and that value that I collected offsets some of the cost of those options should I actually have to be assigned them. What I mean to say there is that premium I'm collecting will go against the intrinsic value. So I can buffer myself with as much intrinsic value hit as I collected in premium. And then once I hit the value of where the intrinsic value matches the premium that I've collected, from that point down, now I'm going to be losing money. Let's try to take a look at some specific examples here. Okay. Now, the first one that I want to bring up is actually a textbook trade that I did. I mean, this is exactly how volatility selling should look like in the most ideal case. And this is on WAL. WAL is a bank. There has been a massive banking crisis that has been out there in the world recently. And WAL was one of the financial institutions that got hit really, really hard. And so I just grabbed a screenshot of this is daily candles of WAL around March 17th, March 15th, somewhere around there, 13th. The banking thing with Silicon Valley Bank and everything kind of started collapsing, and banks took a massive, massive drop. And so what you see here is the share price falling from, $75 down to about $7. Just huge drop. Now, this green line in the bottom, green and red line, this is the volatility of the option chain. And like I said, anytime you have massive price moves down like this, you're going to get a dramatic spike up in volatility. And this is just extremely exasperated. Typically, this particular underlying would have somewhere in the vicinity of, maybe a 30% volatility. It spiked to 400%. And so right here is case number one. For one of the first things is we have elevated volatility. So massive price movement, volatility is sky high. Nobody knows what's going to happen. The price moved, from $70 to $7. That is a huge range. So the premiums for that volatility went through the roof on this particular stock. So the trade here, the idea is once you see this elevated volatility, the option chain is going to be very rich in premium. So we would want to look at this underlying, say, hey, do we think this is going up, down, nowhere? What do you think? With this amount of volatility, the amount of premium is huge. So it takes the break-even point and it can shift you very, very far away from your strike that you sell. So this is where I wanted to step in and sell volatility, sell premium. So I didn't actually do it here on this big drop. I wanted to see what's happening. So I actually sold it around this first red candle, beginning of the second red candle. I can't remember the specifics, but right there, we were still in this elevated volatility. You got a little bit of price stabilization. Some of the media reads and everything were like, yeah, maybe this won't be so terrible. So I wanted to get in there and sell this volatility before it started to contract. My thesis was it was going to contract. I thought, you know what, WAL is going to recover, price is going to go back up, volatility is going to come down, so I am going to sell a put. When you sell a put, you think the stock is going to go up or nowhere. And sure enough, what you see here is the volatility begins to slide down. Okay, so this is that mountain is going to be melting because volatility is coming down. That is going to reduce the premium prices quite significantly. And the other thing about that mountain is theta is decaying because time is going by. Now, what my trade was I sold an at-the-money put. Now, normally when I premium sell, you'll hear me talk about a 30 delta or something, maybe a 16 delta, 20 delta. I'm typically selling very, very, very far out of the money. And the deltas are how far out of the money you are. Because this was just a massive shock to the system here, I was quite comfortable with this particular underlying at its value of around $35, $32 to selling right at the money. It was actually trading at 32 when I sold it. because I wanted to capitalize the most on that mountain. So remember, that mountain is highest right at the money. So when I sold this option on the 20th of March, I sold it right at the $32 strike, which was where the underlying was at, collecting the most amount of premium. Now, once I had that premium of $7, now my break even would be $32 minus $7, because I collected $7 from the trade, which allows me to basically go $7 into the money before I start losing, before I go below my break even. And that was important to me as one of the factors into selling at the money, because there was so much volatility, because the premiums were so high. It pushes out that break even really far. I mean, $7 out on a $32 stock is a huge amount of buffer. So on March 20th, I sold this for $7. Now it represents 100 shares, so I collected $700. And as you can see from there, price, I wouldn't say skyrocketed back up, but it didn't go down. So it stayed out of the money. And that is pretty much the most picture perfect thing you can do, is stay out of the money and get this volatility collapse and have your time passing. So, I mean, this is all the stars were aligning here. Everything was set up. And on March 31st, I decided to close it out. I typically try to close it out once I reach about 50% of the premium that I collected. So the ideal case in my normal would be to close this out when the option was trading for around $3.50. In this particular case, I wanted to hang on a little bit longer because this was such an exasperated move. I wanted to try to get a little bit more of that collection. And so once I really reached this, the option price reached $1.98, I decided it was time to close it back. You can see by the price action, it wasn't, significantly kind of coming up. It was just kind of meandering, small candles, things settling. And, I have other things to do with my capital. I already had about 72% of my potential profit. So it was fine to close this thing out, shut it down. And so on the 31st, I bought this back for $1.98. Now, that is that mountain melting. And we skied down the slope a little bit because we got our direction right. So we started at 32. It was about 35.50 when I closed it. So we went down that slope as well as the mountain melting. You get both of those things together. And like I showed here we are. Mountain melts, price moves up, we ski down. And that is how we were able to get that option bought back for $1.98. So collected $7 when I sold it. $700 is what that effectively represents. When it was time to close it, I had to go buy that option for $198, which means I pocketed $502, which is the difference between what I sold it at and what I bought it at. Absolute textbook, perfect example of exactly what premium selling is all about. The next trade that I want to go over is very similar. It was also in the banking field, and it was FRC. And this trade did not do as much of what I wanted it to do. And this is where I want to call out one of the most beautiful and things I love about this strategy of premium selling. I did not get the direction right. However, there was some volatility collapse and there was time passing. So because of those factors, the mountain melted a little bit. I went the wrong way on the mountain. So I was kind of battling against that, but I was still able to close this out for a profit. So let's take a look here on the left. Again, this is that banking quite fiasco, freak out. Around here on this second red candle from freak out mode, just before it hit this low of 1152. The day previous to that is when I sold. This was also March 20th. I went in, I looked for two really volatile trades. I took FRC and I took WAL. I sold again at the money, put $19. So here is another example where I'm like, okay, this is such an elevated move. I'm going to go right at the money to get the most of that peak mountain. Normally, I'm going to play farther out of the money so that I give myself more buffer, more room, and more cushion. But because this was so much, I wanted to go right at the money, and $7.20 push my break even, down to 12.60, 12, down really, really far. And so again, I looked at the 30 to 45 days. Now look at the volatility. It basically went up a little bit more after I sold it, kind of bled off for a day, but then started going back up again. And so notice this is not as convincing of a rubber band contraction like we had in WAL. WAL kind of went up and started skiing down the slope. And then you can see here towards the tail, the volatility didn't really contract with a high rate. This also contributed to my, okay, let's just step off. Volatility is really kind of not contracting that fast. It is contracting. We're getting some theta burn, but let's move on to something faster. Here in FRC, you kind of have this real slow slope and this very, very weak price action. So it's kind of went 19. We dropped down $8 into 11.52. And then I'm like, yikes, because that is even below my break even. And so we kind of came back. That's the bottom of that candle. Kind of came back from that, but then just kind of has been meandering around this $13 to $14 range, which is still significantly in the money for me because I sold that $19 put. And so, volatility wasn't really coming down. It is a little bit, but in the grand scheme of things, it wasn't that rapid decline, and time is passing. So these are the two things that is kind of melting the mountain, but the mountain didn't melt so strong. And I had the direction wrong, which means I was going, into the money. So I have an intrinsic value in these options. And I have to battle back against that intrinsic value that I have going from the theta from the premium that I collected at the beginning. And so on the 31st, I really just wasn't happy. This wasn't working out the way that I want. It was moving against me from a directional perspective. That theta burn and that volatility contraction still were happening. So I was able to basically get some of that melt and some of that premium back, but not much, because this $19 put was still selling for $6.30. Now, part of that $6.30 is because it was in the money. So at $14, it's $5. So $5 of that $6.30 was in the money, intrinsic value. And so that $5 I can't get rid of. That's just stuck there because we're in the money. So there was only about $1.30 of extrinsic value at that point in time, but I was able to melt off enough so you can see I was still able to buy it back for less than I sold it. So it wasn't going the right way. Here I was able to exit for $90 in profit. That's the difference between $7.20 and $6.30, which was 13% of my potential max profit. Now, the stock moved $5 against me. If I had traded shares, I would be, $500 in the hole. But because we're trading this premium and we're, selling that mountain of price, I was able to let that melt down and still come away with green, even though price moved $5 against me in the process of those options. So that brings us to the end of this week's episode, a detailed look of the option chain and how the premium selling mechanics really work. It is not super glorious. It's not super exciting because, your max profit is right there when you sell it. So you're not going to get these huge, windfalls of going to the moon. You're kind of capped at your max potential profit. But the benefit of this trade for me is you have a high probability of success because you are selling when the mountain is tall and there are natural things that are basically just going to help erode that mountain, that time going by, and then the high probability of a volatility contraction because you're starting at a time when that volatility is elevated. And this really kind of puts a lot of factors in your favor. So I think of this a lot like in the casino where you have your odds at the different games, right? Blackjack is the only one where the probability is above the house's chances of winning, not by much. In this particular trading technique that I have, depending on where you're selling and what you're doing, you're usually looking at probably in the range of 70 to 80% probability of success with each of these trades. And so I really like that because you book little winners along the way. Like I said, they're not huge. I always liken the analogy to baseball, where you're going to be hitting a lot of singles. You're never really going to hit a grand slam. You're never going to really hit a home run. You're just going to go single after single after single. You get a couple of strikeouts, but chances are, if you keep nailing enough singles, at the end of the day, you're going to have more points than the other team if you're constantly, they're trying to hit for those grand slams and things like that. There's a great feeling when you get in a trade like I called out there with FRC, where you sell the premium, the stock moves the wrong way against you, and you are in the money on the option, but you can walk away with a profit. So that to me is one of the best feelings of the option trade, where you get into that mindset or that situation where the price and the underlying moves in the wrong way, but you're still able to have a profit. Now, if it moves in the right direction, you hit your profit targets very quickly because you'll ski down the slope of that mountain. The mountain will erode at the same time, and that's really fun because you get to cycle through your trades a lot faster. And when it comes to premium selling, there's really only 3 directions that a stock can move. It can go up, it can go down, or it can go nowhere. And the trading mechanics of selling premium, you will profit if the stock moves in your direction or goes nowhere. So out of the 3 possibilities of what can the stock do, you profit in 2 out of 3 of those situations. And you could also throw in there that when it goes down, as long as it doesn't go down too much, you can also still win. But I think it's pretty easier just to abstract that out as to 3 possibilities. Up, down, nowhere, you profit out of 2 of the 3 directions. This is what I'm always looking for in the market: elevated volatility to sell it. With a lot of the panic and uncertainty out there in the market, this is very prevalent in many different tickers. I will continue to watch for them. I will continue to post them in the Discord. Hopefully this helps you understand them a little bit more. And you can do your own screening. You can look out there. You can follow along when I'm putting them in the Discord and understand it a little bit better. Good luck out there. And remember, think outside the block.